So good afternoon. Thank you very much to AIM Summit for hosting a second panel moderated by AIMA. And I think it's fair to say that AIMA's probably well known as the trade association that represents hedge fund managers. But since 2015, we have been focused on private credit managers, and we also represent them to policymakers and regulators globally. Tomorrow, we have coming out a paper that we've published for the last 7-8 years, Financing the Economy 2022. And whereas last year that was very much focused on ESG and private credit, this year it's focused on borrowers and private credit. So as Tom just said, www.aima.org, and you can download that tomorrow from our website. But enough about that. I'm very excited. We have 3 seasoned private credit professionals from different regions who are going to talk to us about the current trends and what we should be looking out for. So in the first instance, I'd really like each of them to introduce themselves and briefly talk a little bit about the investment objectives of their firm. So starting on my right, Bhupinder.
Thank you very much. So I'm Bhupinder. I am the Global Head of Leverage and Acquisition Finance at FAB. So anything to do with acquisitions, fund finance, structured event situations is what I look after at FAB.
Thank you. Good afternoon. Thank you for inviting us to be in the panel, and thank you for everything AIMA does for us throughout the year, Fiona. My name's Edgar. I'm the CEO and co-founder of Tresidor Investment Management. We're a London-based alternative credit manager. We manage both a lower directionality hedge fund and a higher return long-only credit opportunities fund. In terms of our objectives, we seek to deploy capital into all of the different verticals of European corporate credit for our investors, the idea being to create a more through-the-cycle return profile than is possible in our view by selecting ex ante where the money's coming from next year.
Thank you. Well, thank you, and pleased to be here and join the interesting panel. It's a pleasure to be back in the region after where I've spent 14 years before returning to Asia in 2018. Cabot Capital is the firm I established. My name is Serge Lipin. We focus on private markets. It combines advisory services as well as fund management services, work with family offices looking at building portfolios in Asia, as well as institutions looking for guidance in allocating capital to Asia as well. We also seek to put in place asset management strategies or specific investment strategies, taking advantage of opportunities across Asia.
So thank you very much. So each of you are sitting in different parts of the world, and I know private credit can mean different things to different people. It can be a catch-all for a lot of different credit strategies. So as we're in the Middle East, and starting with Bhupinder, could you just maybe tell us what private credit means to you, and what are the current opportunities you're seeing?
Sure, thank you. Private credit, I think in the US, in Europe, has been an established asset class for 10, 15, 20 years, and also the fastest growing probably. In the Middle East, it's slightly smaller than that. I think there's a bit to go there. You know, in comparison, we've had about, I think, $1 billion or so of AUM of sort of true private credit funds in the past 8 to 10 years. But the loan market has been about $150 billion just last year. So put things in sort of context between the two. So here in the Middle East, with the excess market liquidity from all the banks and the higher focus on sort of high credit quality, what we see is probably the SME space is where there's an opportunity for private credit investors. We see venture debt sort of being almost a sub-segment of that private credit segment to be one which has attracted a lot of interest lately. There's been sort of some announcements from Chimera committing $2 billion or so to this strategy in the region, and some sort of US and European investors looking at say, slightly, should we say, non-performing type credit situations, which is where I think there's a bit more of an opportunity in the Middle East, at least, just because of that oversupply or excess supply of bank market liquidity, which is sort of at the higher end of the credit grade. So yeah.
Okay. Thank you. And moving to APAC, Serge, I know that you've said that, I think you said private credit in Asia is quite nascent. It's probably where private equity was 20 years ago. Could you expand on that a bit more and tell us where you're seeing those opportunities?
Yes, indeed. Just as a quick background, non-banking financing essentially began with the Asian financial crisis in the mid-90s, where distressed bonds were being acquired. It evolved into distressed debt for private companies, and more recently, there's been more momentum focusing on direct lending. Typically, sponsored credit, where funds like Bain's and Ares have been quite active, and non-sponsored credit is just beginning. So I feel there's a lot. We're in the very early chapters of non-banking lending in Asia. For instance, the market is largely dominated by commercial banks, with probably 85% of financing provided by commercial banks. From a global allocation, private credit is about 7% of international investors versus 31% for private equity into Asia. So really, I was in Asia back in 1996, just before the Asian financial crisis. So I feel that the direct lending, as it is, mid-market, sponsored or non-sponsored, is really where PE was when I was first in Asia. So there's a lot to come from the traditional commercial lending, and there's other verticals to be considered as well, which are venture debt, NAV lending. All of those strategies are barely active in Asia as well. More to come.
Thank you. And then Edgar, moving back to our home. You have an interesting definition of private credit. I think it's fair to say it's been slightly stolen by, the terms being sort of, stolen by lots of different credit strategies. Could you just tell us a little bit about this and where you're seeing the opportunities?
Well, I think 5 years ago, you probably wouldn't have invited a firm like us to be on a panel speaking about private credit. But yeah, I think the phrase, particularly in Europe, has been broadened a lot. It used to be synonymous with private lending. I would say that there's at least 3 things that we do that very much fall within the definition of private credit. I think one of them is special situations, investing into non-publicly listed companies. Even if we are investing into a tradable credit instrument, that's a particularly interesting opportunity set this year. So secured credit, performing companies, unloved sectors, misunderstood businesses, targeting 15 to 25% yields, really a much bigger dislocation in some areas than in the market as a whole. That's very interesting. The second is, and this is another buzzword that doesn't mean that much, is capital solutions, which has come to mean really funds like ours providing more sort of financing, refinancing, primary, which is only possible because, of course, primary bond and loan markets in Europe have been largely shut for most of this year, or since February. And so that's allowed us to step into situations where, again, we can lend at typically very low leverage, typically negotiated terms much better than we see in broadly syndicated markets, but still targeting that sort of 15 to 20% unleveraged IRRs. So capital solutions continue to be very interesting. And then what we're not doing at the moment, but we do during the cycle when the time is right, is distressed, classic loan for control situations. We did a lot of that back in 2020, 2021. We have a single position that is pre-reorg in our book today, where we're driving the bus in that particular situation. But we're very excited about 12 to 18 months out as increasing interest rates kind of do go through European financial statements. We've identified a series of companies where just pricing in the forward LIBOR curve is enough to wipe out free cash flow within a year. So we're very excited about what potentially comes in a year or so. But today, I think if you were in a pure distressed, pure European fund, you wouldn't have much of your capital being deployed.
Thank you. So private credit is not just direct lending, it's a lot of other things as well. And staying with you, Edgar, I'd like to hear about how you're viewing the liquidity at the moment in these markets.
Certainly. So I think with liquidity, there's a couple of misconceptions. I think one is that there's an inherently a positive illiquidity premium. And that is very much not the case, certainly not anymore in direct lending, for example, compared to public credit markets within Europe. I think a lot of people have this number, there's 200-300 basis point automatic premium for locking your money up. It certainly can be the case in certain areas, but we would suggest that risk for risk unit, that there's probably a 200-300 basis point negative premium for locking your money up. We tend to find distinctly higher returns from investing into public markets. I think the second misconception is that between investment horizon and liquidity. So most of our distressed investing is typically kind of 2 to 4 year targets. These capital solutions I mentioned, very typical, like a 5-year, 2-year no-call kind of structure. So the investment horizon is, again, typically 2 to 3 years. But these are typically liquid instruments. We can exit these within weeks, if not, at the worst case, months, at close to marks. And so that's very important. And then the final thing I would say is that I think some people are afraid of liquidity because liquidity implies mark-to-market. We do not fear mark-to-market, quite the opposite. We're a fundamental investor. Mark-to-market is something that we can take advantage of. Whether that allows us to upsize in times of weakness, and this year has been very much about buying into strong fundamentals at lower prices, or it is about recognizing that we make mistakes and exiting as soon as we possibly can, taking advantage of liquidity then. So liquidity for us is something that we value greatly.
And Bhupinder, how do you look at liquidity in this region?
Liquidity in this region, I briefly touched on it before. I think there's an excess market, bank market liquidity when we look at the UAE, when we look at Saudi Arabia, generally in the region. Statistically, I think the UAE has something like 52, 53 banks. We're about 9 to 10 million people, so that's probably a couple too many, I think. And generally speaking, again, that liquidity is, however, the issue with that liquidity is that it's focused towards sort of high investment grade sort of borrowers, as opposed to some of the sort of sub-investment grade $5-10 million EBITDA companies are not getting access to that liquidity, and that's where the challenge is, and that's where the opportunity is, really, in this region.
And is that what you're seeing in APAC, sort of this opportunity and a liquidity premium?
Well, just from a liquidity perspective, with regards to supply-demand, one would intuitively think that there's plenty of capital available, with banks dominating about 85% of the lending AUM, so to speak. But if you look at banks tend to favor larger borrowers. They have a fairly rigid framework to lend. And during COVID, they've also retrenched. International banks have retrenched a little bit from Asia, as well as regional banks have retrenched towards their core markets. The other data point that is worth noting is when it comes to mid-market SMEs, they account for about 47% of GDP, at least in relation to Southeast Asian markets. And at the same time only use 17% of bank financing. So from that perspective, there's a shortfall of funding for the SME, and that's part of the opportunity set that non-banking lenders are trying to take advantage of. Then from a product perspective, it is illiquid, so to speak, besides the cash yield, which is welcome. You would be looking at horizons of 18 months to 3 years. That's probably the range which independent lenders are looking to be refinanced, because it's not the cheapest financing. However, it comes when the commercial banks is not comfortable lending. So if a SME is looking at expanding geographically, broadening business activities, those dynamics may not provide comfort to banks, and that's where the independent lenders come in at a price.
Yes, but this is providing the lending facility that, as you say, banks have possibly been disintermediated out of, and in order to keep economies growing, you
Yes.
need.
And it is just, yeah, exactly. it's also often seen as much less dilutive growth capital to some extent, and there's a fine line to maneuver.
Okay. Thank you, Serge. I just wanted to touch briefly on a topic that our previous panel focused on. It's something that's not going away. It's extremely important, and it's also a topic that we focused on last year when we were doing our Financing the Economy paper 2021, and that is ESG. And I think that when we were chatting on the panel call, Bhupinder, I was slightly surprised at how sort of excited you were sitting in the Middle East talking about ESG. I'm sorry if I did you a disservice, but I'd be interested to hear.
No, absolutely.
How
and I think,
looking at.
And I think it's a Middle East excitement in general, to be honest. We had COP27 in Sharm el-Sheikh. COP28 is going to be in the UAE next year. Every single borrower, every single company, whether they are sort of a natural resources company or not, are talking about energy transition and setting up sort of frameworks for the next 5, 10, 20 years. And so it's a phenomenon in the region that you see. We had just a month or two ago, we have PIF issuing a green bond, first one for them. And in quite challenging, capital markets, I must say that I don't think they needed to do that, but it was just another step that they wanted to be the first one to do that, and very much, therefore, it's a debate in boardrooms. It's a debate with clients. It's very active. I mean, as an institution, we have, I think, something like $80 billion of commitment that we have sort of committed to do before 2030. So every institution, every borrower, every lender sort of seems to have some sort of commitment and are very keen to try and make a change for ESG, for the better. And I think ESG, it may just be 5, 10 years down the line. It could just be sort of normal as part of our sort of LMA documentations and certain provisions that are there. It just becomes standard, and we may not sort of talk about it as much because it becomes part of our everyday of thinking in the credit markets, so to speak.
Thank you. And when you talk to your investors, what are they asking you? What are they forcing you to think about when you're structuring funds and you're marketing? Yeah, Edgar.
Yeah, so we certainly, we're asked about ESG all the time, of course, and thank you, Emma, for your ESG due diligence questionnaire, which we use. I think it's very early stage for ESG. I think a lot of investors are not entirely sure what they want. There are greatly changing standards in data and governance. But we've been asked by one investor to report emissions for the portfolio. It's a credit portfolio. It's difficult to do. We spend a lot of time looking at it. And then we found some results that surprised us. We were looking at Bloomberg as an example, and I give them plaudits for their transparency and their willingness to engage, because we had an investment in a shipping container company that is hugely profitable this year, as you would expect from that industry. They're making 1,000% of their normal EBIT this year, and we would expect their emissions intensity to dive, but instead it was increasing. And so we contacted Bloomberg, and we understood that the model basically said, normally they have a certain emissions intensity. They're making 10 times that money. They must therefore have 10 times the emissions, which absolutely wasn't the case. So again, plaudits to Bloomberg, and then they're retraining the model to change that. But in the meantime, that company is being penalized for emissions data for those people who care about it. I think that's interesting. And then the second thing I think is also just behaviors. We are seeing some people taking a very black and white approach, wanting to exclude entire sectors, for example, rather than looking at the good actors and bad actors maybe within a sector. And so some of the capital solutions trades I referred to that we managed to source, some of them have been because, for example, classic private credit funds, a lot of them are Article 8 funds in Europe. They've tried to minimize their exposure to oil refining full stop. That allowed us to earn an 18% IRR from investing with less than 1 turn of leverage for a Swedish refiner that actually is a heavy renewables user. So there's even a sort of a green angle to the story, and yet a lot of the private credit funds were unable or unwilling to kind of step up to that, allowing people like us, who again, we have ESG criteria, we care about this, but these guys are good actors. They have a heavy focus on renewables, 18% IRR for less than one turn of leverage, precisely because other people apply ESG at times in a very unthinking way. So I would say, it continues to be a source of opportunity for us at the same time as taking it seriously and respecting it, because that's what our investors want us to do.
Mm-hmm. I guess in Asia, it's also, we're early days in implementing ESG. ESG is a very, very broad subject, but while PE or controlled buyout funds have more influence on how a company will implement ESG initiatives, creditors have less influence. And what we've seen is designing incentives and disincentives. So if a company achieves their objectives, they may enjoy a reduction in borrowing cost. And if they miss it, then they may have to pay a little bit more. But clearly, that theme is front and center across capital, whether it's PE or credit lenders. So there's an influence on how entrepreneurs will behave, or there will be exclusion of sectors as well, which creates other opportunities as well. And we saw ADB supporting a significant commitment for coal transformation or coal reduction in Indonesia, for example.
Thank you. And very briefly, we have just produced another DDQ, you'll be pleased to know, managers, focused on private credit and how managers and lenders are looking at ESG. Before I ask the panelists a final question, have we got any questions from the audience?
Everything is very
There's a
clear.
gentleman over there? No. Okay, let me move on then to our final question. What do you think are going to be the main challenges / opportunities for the year ahead? We're nearly at the end of 2022, unbelievably. So what are we going to look for in 2023, barring any lockdown situations and assuming a reasonably normal landscape?
Shall I go first? Yeah. So look, from our perspective, the rising sort of interest rate environment, I think, implies an increased sort of cost of funds for banks, and in an environment where, and also a borrowing cost for borrowers, and just a forward rate from a risk perspective. So when we look at, and we spoke about the excess liquidity in the Middle East at least, when we price that liquidity and in the context of credit risk, it's something to be mindful of. In particular, because input costs to most borrowers are going up, commodity costs are reasonably high, and that sort of credit risk needs to be priced appropriately in an excess or a liquidity environment. I think is definitely one of the challenges. In terms of opportunities, I think the one of the good things, at least, is in the Middle East, we're not necessarily, at least in the next quarter or two, looking to go into a recession like perhaps other parts of the world are. So it's still buzzing. There's still a lot of infrastructure investments happening, whether it's in Saudi, in the UAE, or other parts of the Middle East, and that growth will still bring a lot, sort of along opportunities for credit lenders, for normal lenders, etc. So I think that's probably from my perspective.
Okay, let me move to Asia, Serge.
I guess from a challenge perspective, one of them could be perception. I mean, the 7% of global allocation to private credit is justified from a number of sources, and one of them is foreign investors being comfortable with Asia. Asia is more than China. There's a lot more Southeast Asia as well. So that marketability or awareness or familiarity is something that has to be worked on, and investors should make an effort from that front. There's a diversity of foreign exchanges dynamics in Southeast Asia. That is a challenge. Often lenders can lend in US dollars and transfer the FX risk to borrowers. Sometimes you need to edge yourself when it comes to more developed market, Australia, Hong Kong, Singapore. Jurisdictions have been improving and will continue to improve beyond Hong Kong, Singapore, and that is very favorable. But those are challenges. From an opportunities perspective, the direct lending, well, direct lending or non-banking financing is nascent. There's many other verticals that can develop beyond increasing market share of direct lending. I mentioned venture debt is a topic that is surfacing. The venture industry has been developing quite fast in China, in Singapore, and along with that should be the beginning of venture debt industry. NAV financing is another subject that is very common in the West and has yet to build scale in Asia as well.
Thank you, Serge. And I'm going to give the last word to Edgar.
Thank you. Well, as I mentioned earlier, distressed debt is not this year's trade, and I think there's a risk of being too early in there, but we're very excited about it 12 to 18 months out. This year, and I think extending into next year, we like misunderstood cyclical, for example, autos and auto parts. We find some really interesting investments, auto parts suppliers that have been sold off despite being very low leverage, having passed inflation through their contracts to the OEMs. You're attaching a 20 to 40% LTV, and you're earning 20 to 30% yields for that sort of investing because other people just don't want to be in autos because it was cyclical the last time. Some of these companies are not in the cycle this time, and all of that presents really interesting opportunities.
Edgar, Serge, Bhupinder, that's been an extremely informative panel. Would you please join me in thanking our panelists?
Thank you.
Thank you.